So, welcome everyone to another installment of Coffee with Carl. I have the pleasure of introducing today Phil Argue. Phil is with Signature Investment Advisors. Phil's been a guest in the past and longtime partner of my firm. We rely heavily on their investment expertise. So today, I want to spend a little time getting a better understanding the backdrop of what's going on with the economy, where the market's going, and really just try to push through some of the noise because there's a lot that comes out of Washington. That's been a big topic as of late. How that's affecting and why that hasn't affected the market. So really, we're just kind of very far-reaching today. Just try to address any of the hot topics. And as I mentioned prior to coming to the call, anyone that has any questions, feel free to send it in. So with that, Phil, welcome, and I'll go ahead and turn it over to you.
All right. Thanks, Carl. Let me share my screen here. Okay. So yeah, as Carl mentioned, I've got a number of slides that we can, zip through. At any point, stop me. This can be, conversational. Yeah, don't be bashful. So, as Carl mentioned, give you just a sense of our view of the world. There's obviously a lot going on, and yes, as Carl mentioned, it seems like every week there's something new coming out of Washington. Yesterday, it was the Supreme Court hearing the case on Trump's tariffs, if those are going to stick or not. So next week it's going to be something else. But I want to start with one slide here, and nowadays, especially with the way society is today, everybody's on their phone. Everybody focuses on the short term, right? What happened this week? What happened last week? In this first chart, it's just a reminder, like this is the long game. And so as much as the news cycle is, what happened yesterday, what happened today, this chart goes back 40 years, back to 1985, and this is the return of the S&P 500 in the blue bars. The red little dots down here at the bottom is the peak to trough decline in each year. So how much, if you started at the beginning of the year, you went up to the top, how much did the market drop, intra-year? And so this year we were down 19% on April 8th, before Trump, rolled back the tariffs. We're up about 15% now. And so the message here, a couple things. I know there's a lot of noise. Most of it doesn't matter. What Trump puts out on Truth Social, maybe the market wiggles a little bit. But the fundamentals of the economy are far removed from that. They don't respond that short term. The other thing I want to just point out here is just a hidden thing. Over these 45 years, or excuse me, 40 years, the S&P's averaged a little over 10.5%. Now, most people, you'd say, hey, 40 years, 10.5%, okay, about 400%. But due to compounding, right, the effect, it's almost 4,000%, right? So there's always some news out there that's gonna spook you. Equity valuations are at all-time highs. Is there an AI bubble? We'll touch on all of these things, but don't let those things disrupt your long-term plan. Because what you don't want to do is affect, the power of compounding. And so that's sort of the hidden message in this slide. One, to provide some context. Hey, we're going to have some ups and downs, but long term, the power of compounding is something we don't want to get in the way of. So, and just so everybody's aware, so I am one member on a 10-person team. It's the Department of Investment Management and Economic Strategy at SIA. And so every day, 8 a.m. every morning, I just got out of our daily meeting. We come together and we try and figure out what's going on with the economy, what's going on with financial markets, and where should we be positioned. And so I've kind of coined this macro versus markets paradox. And this is really sort of a summation of the debates that we have had amongst our team over the last, call it, 9 months. And on the left-hand side, we have some members of our team that are very steeped in history. They've gone back and studied economic cycles from the 50s, 60s, you name it. And all of these things on the left-hand side are things that have historically happened that should be bad news, right? The yield curve inverted. It was the longest yield curve inversion in history. If anybody doesn't know, that's short-term rates being higher than long-term rates. That's not usual. But we've had an inverted yield curve for the longest period in history. That's usually a bad thing. Payroll growth has slowed substantially. Well, we're going to talk about that quite a bit. But we added 29,000 new jobs over the last 3 months that have been reported. Obviously, we don't have a payroll report currently because the government is shut down. The manufacturing sector has been in the longest contraction in history, going back to the 1950s that we can measure. Consumer sentiment is at 2008 levels. So back to the financial crisis would be the last time that we saw consumer sentiment as low as it is today. Housing activity, so new homes being built, is down 30%, worst contraction since 2008. Gold is the top performing asset this year. That's odd. It's usually the sky is falling sort of thing. But all this and equity valuations are at or near all-time highs. And you go like, how could you be positive, right, on what's happening? And so we have a contingent on our team that weigh these things more heavily on their side. On the other hand, if you take the internals of the stock market, and actually this is a quote down here at the bottom, Stanley Druckenmiller it was a longtime hedge fund manager. He runs a family office now. He is actually the mentor of Scott Besson, the now Treasury Secretary. And a famous quote of his was, "The best economist I know is the inside of the stock market." Okay. And so if we look at the stock market, what's going on there? Things that normally happen during a bull market when things are good are currently happening now. So consumer discretionary outperforming consumer staples, right? People are buying, cars versus, Clorox or, toilet paper, right? So which one of those groups is outperforming is informative. That's making new all-time highs. Broad cyclical sectors versus defensives, same thing, all-time highs. We're now at, I think, 35 new all-time highs this year. I maybe missed a couple over the last couple of weeks. Second quarter earnings for the S&P, all-time high. We're in the middle of third quarter earnings season. It will be another all-time high for corporate earnings. Home builders have actually had a good year this year. Believe it, the stocks of home builders, even though housing activity has been down. Financials have been doing well. And companies can borrow money freely. We'll touch on this a little bit when we talk about AI. But the premium that investors require to lend money to a business or to a corporation instead of the government is extremely narrow, meaning that people are willing to lend money, investors are willing to lend money to corporations freely, which is a good sign for economic growth. So this paradox that we've had, the kind of push and pull between these two, what has worked historically, so far hasn't worked this time around. A lot of these things have been flashing red signs for a couple of years now, and it hasn't happened. And so I don't think we want to ignore these things on the left-hand side. They will matter eventually, but we can measure the things on the right much more timely because they update every day. We can track the internals of the stock market, and all those things are extremely bullish at the moment. So very constructive. So let's talk a little bit about what's going on in the economy. So just for background, in the first quarter, we did have a negative GDP print, and everybody thought, okay, we're going to go into a recession. It coincided with Trump rolling out these tariffs, and the stock market was down 19%. We talked about. So the second quarter, we had this huge surge back. So the second quarter was 3.8% GDP growth. That's real, accounting for inflation. If you didn't account for inflation, the economy grew at a 6% annual pace. That's this gray line. And the gray line is more important because it tends to correlate very well with revenue growth for S&P
companies.
Has bounced back. And we'll see where we go for the third quarter. Of course, we're not going to get that until the economy or until the shutdown ends. But what's weird about this is that we've had this resurgence in economic growth, but payroll growth has fallen down. So this is the last 10 years. Every one of these gray bars is the number of jobs that were added in a month. The blue line is the 3-month average. Okay. And you can see we've come down here, pretty much the weakest job growth outside of COVID because we shut the economy down then. And so it's kind of a peculiar situation we're in. So the economy is bouncing back, but it's doing so without without labor at the moment, at least temporarily. So this is another thing that kind of gives us pause. And I think if we enter a period where the labor market is contracting, we are losing jobs. There is a serious risk that I think that the tone of the stock market changes. And so we want to kind of dive into this a little bit. So if I took that blue line that I just showed you, the last one was just the last 10 years over here on the right. This is a long-term chart. So this is going back to 1965. And each of these, the gray bars are downturns in the economy. Those are recessions. And you can see usually when this goes negative, it corresponds with a contraction in the economy, right? Going back over this entire time period. Now, it's possible that we bounce back and job growth recovers. We did see that in 1966. We had a short little slowdown. Back then, the Federal Reserve cut interest rates. They were able to keep the economic cycle going. So it's certainly possible. But this is unusually weak. And so a couple of months ago, we kind of took a deep dive into the labor market, try and unpack what's happening here. And so we took apart the job report that comes out every month. Again, once the government reopens, we'll get it. But we took all the individual industry groups that you would say, hey, these are the things that are the most cyclical. They're the things that are going to probably turn down first. So construction jobs, so people building new structures, trade payrolls, durable goods, computer and electronic products, car sales and car parts is an important one. We've got gambling and recreational payrolls, so people working in casinos, things that are more discretionary oriented, and food services. And so the gist here is that we took all these components and built our own little cyclical labor indicator here. And it's the blue line on the left-hand side. The gray is the year-over-year change in payroll. So when we go to negative, that's when bad things happen. This was 2008. This was 2001, the dot-com kind of bursting era. Both of those were recessions, and then there's COVID. And so the gist of what this is saying is that yes, the labor market is slowing down, but it's not as bad as we were back in early 2008, which is this red dot is January of 2008. It's the first month that we entered a recession, or in 2001, the first month of that recession. So the labor market is weak, but it's not falling off a cliff is sort of the read here. And how we can kind of make sense of it. On the right-hand side here is we have the labor force. So how many people are in the country looking for a job, whether they're working or looking for work. And it's recently turned down. The foreign-born labor force has turned negative. And now that makes sense, given the immigration policies the administration is pursuing. We're not seeing positive immigration. And so that's pushing down that monthly payroll report, number of new jobs that we've seen. But importantly, we're not seeing a serious acceleration in layoffs. I know there's been some headlines recently of some big companies that had some big layoffs. I think Intel was laying off 20,000 employees. I think Amazon was doing 18,000. So there has been some news of that in the headlines. However, last week we had a Fed meeting and Jay Powell was asked this question, and they are still getting initial jobless claims data. So every week, every state releases how many people file for unemployment insurance. It's probably the best read on sort of the labor market. Now we're not getting that data because the government is shut down, but the Federal Reserve is still getting it, so it's just not being published. And he said there is no increase in layoffs. So in aggregate, while we're seeing some headlines, it is not representative of broad layoffs, affecting large swaths of the economy. So, however, this is not. I don't think we're entirely out of the woods. Now, I'm going to share something that this is not a today problem. This is probably a second half of next year problem, sort of thing. But the point here is that weakness in the labor market usually starts in construction. Now, makes sense. Construction is highly interest rate sensitive. So when interest rates go up, homes become less affordable. Home builders build fewer homes, and therefore they employ fewer people, right? And so usually we see weakness show up in construction first. And so let me explain what's on this graph here. So we're looking at three groups of payrolls. The one that really matters is this dark blue one that doesn't drop very much. Now we're looking at the percent decline in each of these groups. So total non-farm payroll. So that's everybody, with a job. It's about 177 million people as of right now. And so during 2008, we saw about a 6% decline in total jobs, right? And the unemployment rate spiked up. And so that's about 170 million employees. If we look at construction jobs, that's about 5.5 million people. This includes, roofers, electricians, framers, people working on new home builds. That's about 5.5 million. And if we just look at a subset of that, this group down here is just building residential construction. So they're the people that are building new homes for home builders. There's about 980,000 people in this group. So it's a much smaller subset of construction, and construction is a small subset of overall payrolls. But if we look at where the weakness comes before each of these prior recessions, so this goes back to 1985, by 1987, 1988, residential construction payrolls started to turn down well in advance of construction payrolls, and construction payrolls turned south before overall payrolls went south. And so what we've seen so far is construction payrolls have been positive. They've been growing. Residential hasn't recovered from 2008. Efficiencies in building new homes and whatnot, but construction payrolls are up here making new all-time highs. So because this is a percentage off, a graph that measures the percentage off a new all-time high, when the lines are all the way up here, that means we're making new highs, right? So more people are working in construction than they have. However, over the last 12 months, this little box down here, we've started to see these things turn down. It's such a small amount, you can't even see it on the graph over here. But we've seen them start to turn down. Now, it will take probably, like I said, it could be 9 months, 12 months, but at some point, this would be the next one of those macro things that haven't mattered yet that we're keeping an eye on in case it does start to matter. Now, the curious thing with this is on the left-hand side, I mentioned home construction is down 30%, and this kind of gives you a sort of a look at it. On the left-hand side is the number of housing units that are currently under construction. And at the peak here, we were building 1.7 million new units at an annualized rate. So 1.7 million new homes, excuse me. Now we're down to about 1.3 million. And so what's odd is how are home builders still employing the same number of people when they're building 25% fewer homes? And the reason is on the right-hand side. So we took the 8 largest U.S. home builders, took all their financial reports and looked at their operating margins. So this is the average of all home builders, of all the top 8 home builders, and their operating margins right now are at 14.2%. Okay. That's quite high relative to history, right? They've operated more kind of in this 10% range, after the financial crisis and before COVID. But what happened is we had such a huge increase in home prices following COVID that their operating margins, they became extremely profitable, right? They got up here to all-time highs, almost 20% operating margins. They've come down. Now, at some point, executive management at some of these home builders is going to have to make a difficult choice. Like, hey, we either need to start building more, which means the market needs to improve for new homes, or we need to start laying people off. And so, I don't think this is a this quarter thing. I don't think it's a first quarter of next year. But we can kind of follow the path of, okay, logically, home sales continue to decline, operating margins continue to soften. At some point, they lay people off, and that is a leading indicator of something that we would expect to materialize 12 months, 18 months out in the future. So that's the one macro thing that we're kind of keeping an eye on, that makes sense as to, hey, the labor market is soft right now. It's mostly immigration. But under the hood, we can see a path towards it getting weaker, and we want to be aware of that so we can adjust portfolios and preserve capital if that does materialize. Um, okay, now I'm going to completely switch gears. So now we're going to talk a little bit more short term, but policy things that have come out now. Unless there's any questions on labor market, all of that, I want to take a breath and take a sip of coffee
I got
before we switch gears.
I think I got two for you, Bill. How does, we talk about, the number of jobs, et cetera. How do you guys factor in that with the government? Because obviously the government was one of the biggest employers, and part of Doge was to shrink the amount of government expansion, spends, et cetera. So how does that factor in? And then the other question I was looking at, or maybe it can go and dovetail into the next part, was this operating margin. Do you guys think about that maybe just writ large, right? And how the tariffs, we haven't really seen increase a lot of the, call it, tax that generates from tariffs. We haven't seen that necessarily flow through into prices yet. Do you think that it's just a lot of the elevated margins that these companies built out over the last couple of years have a factor there?
So, okay, yeah, two different things. Well, let me come back to the margin one because there's I think more ambiguity around that one. But for payrolls, let me go back to we about 2 months ago we did this deep dive where I mentioned this. We built this little composite for the labor market. A couple interesting things about just where there are jobs and where. So government jobs are about 2 million. There's about 2 million people work for in government jobs. And yes, federal government jobs are shrinking, not by an alarming amount. I want to say it's like a 3% reduction year over year. But it's entirely offset by state and local governments have actually increased labor. So there are more people working in the government today if you include state and local. The one other thing that I'll mention, which I think is a pretty staggering observation that we made, I probably should have included the chart, but 2/3 of all the jobs created over the last 12 months are in one industry group, and it's healthcare. So there is, you would think healthcare, and it makes sense, right? There is we get an aging population. People live longer, more people retiring. And so healthcare is less cyclical. So we kind of look at that as maybe there's a little bit of buoyance to the labor market because so much of the jobs that are being created are in healthcare. That maybe provides a little bit of support under the labor market, maybe makes it a little less cyclical. So that was the two observations. It is really unfortunate what's happening with the federal government. Every night you turn on the nightly news and it's people that are struggling to make ends meet. But in reality, they are a very small percentage of the overall labor force, and so I don't want to discount what they're going through, but on an aggregate, they're not going to move the needle on the overall economy because it's just too small of a group. Which is why you also see the labor market or the stock market doesn't really care too much about the government shutdown because we're not investing in the U.S. government. We're investing in companies, that operate, in the U.S. and we're not beholden to the government being open. So that's the labor market thing. A couple of observations there. On operating margins. So while this chart on the right-hand side was looking at home builders, if we were to do this for the S&P 500, we continue to make new all-time highs. So operating margins have almost never been higher than they are right now. There was a brief period in 2021 where operating margins were higher just due to the surge in inflation. But I think there's a couple of aspects to that. One, the tariffs have ended up not being anywhere near as big as people expected. I think also a lot of companies front-loaded their inventories in the first quarter. So they said, hey, there's the risk of this tariff thing. And actually, this does show up. The reason why our first quarter GDP was negative was because everybody rushed out and bought as much product as they could from China. And imports are a negative reading on GDP. So the economy in the first quarter, while GDP was negative, the economy wasn't that bad. It was just that everybody pulled forward all of their imports so they could sell those products at sort of pre-tariff rates. And so I think companies continue to get more efficient use of technology. I think there's just productivity gains there, and that's not even accounting for AI yet. That's probably going to be a couple of years before we see that pull through. But company profits are extremely strong profit margins. You would expect, I think most economists expect that tariffs are going to start to bite as a lot of that inventory that was purchased from overseas before the tariffs went into effect, as they sell off that inventory and they have to replace it with inventory that's now going to be charged a tariff, it's going to be an impact. But I think that the big takeaway with the whole tariff thing is it has ended up being much smaller than was initially expected. And actually, that's on the next slide here. So, to put the tariffs in context, on the left-hand side over here, is that the monthly tariffs, they call them custom duties from the Treasury Department, but the Treasury Department is extremely transparent. They tell you every dollar that comes in and out, where it goes, where it came from. And this is the dollar amount in tariffs in billions every month over the last 10 years. So our last little trade war with China back in 2018 was this little surge up. It looks kind of cute at this point. And then obviously we had the tariffs that were announced and we saw this huge surge up. And so this does include September, which was just shy of 30 billion is what we brought in tariff revenues. Now, importantly, we saw this huge shot up and the market was concerned about this, but it has started to level off. So it's looking increasingly like we're going to bring in somewhere in the neighborhood of 350 billion in tariff revenue to the Treasury Department on an annualized basis. Okay. Now, on the grand scheme of things, the government runs about a $2 trillion deficit. Even when they did bring in these sums of money over the last several months. So it helps to bring this in, but it's not like we're balancing the budget off of this, right? On the other hand, we've got this new tax bill that was rolled out that's got a ton of really interesting benefits out there. And we call them kind of run it hot provisions, because obviously the goal here is let's juice the economy. So before we got into this, we've got a growing debt problem. The economy, we want the economy to grow faster. We need the economy to grow faster than our debts. And so what they've done is, hey, we're going to put some programs in place, some provisions in the one big beautiful bill that was signed on July 4th, where over a short period of time here, we're going to give some benefits to people, to businesses, to sort of kickstart economic growth in the hopes that we could get the economy growing fast enough so that in the future, the tax revenues that come into the Treasury Department will be higher and we can pay off our debt. Every country in the history of the world that has ever gotten into a debt problem has tried this. Most of them have not succeeded. We'll see how this works, but that's a 5-year down the road problem. That's not a thing right now. What the market cares about right now are these things that we could go over here. So no tax on overtime, no tax on tips, enhanced senior deduction. They were trying to get Social Security benefits not taxed, but they couldn't get that through. So they put an enhanced senior deduction in there. If you buy a car over the next few years, it's going to be like a mortgage. You get to write off the interest, an enhanced child tax credit. All of these things expire at the end of Trump's term, right? So, they're short-term measures. So the deficit is going to increase next year up and through 2028. And the hope is that we're going to kickstart the economy and then we're going to take away all these tax benefits and we're going to pay the debt back. Importantly, with all of these, they don't kick in until April of 2026. Basically, tax refunds for people that are benefiting from this are going to get bigger in April. So my daughter logs a bunch of overtime. She has not gotten she's still taxed the same amount today, even though this bill was signed. She will get a monster tax refund come April. And that's for anybody with tips, overtime, right? Qualifies for the senior deduction or bought a car this year. So consumers likely get a shot in the arm, a little bit of a boost come April through these tax cuts. Um, but all in all, in the grand scheme of things, it's not going to be huge. All of these things are kind of capped. I think the max you could do on the overtime, no tax on overtime, is like $12,000. Same with tips. So there are caps to it, so you can't abuse it. But what's probably more interesting is really these components down here: immediate depreciation on equipment and machinery. So companies that are spending money on a factory, a data center, whatnot, they get to immediately depreciate that, and which means they pay less in taxes this year by by putting shovels in the ground, by starting projects. Same happens for R&D expenses, and so we have seen a ton of companies that are involved in reshoring of manufacturing, building data centers, construction of new facilities that have just had a phenomenal year this year. And a lot of it is due to the amount of activity that is being spurred by these two components. And it's probably the most exciting space that we've seen really over the last 6 to 12 months. The one other thing I'll note, just to point out, we were up against the debt ceiling when the One Big Beautiful Bill hit. We were at $36 trillion in total debt. We're now at 38 trillion just 4 months later. They upped the debt ceiling to 41 trillion. So we'll probably hit the debt ceiling again in another 18 months. That'll be another debate. But so I think this is just evidence that from an investment standpoint, we're putting our fiscal deficit aside. We're not going to try and tackle it. We're going to try and get the economy to grow faster. And at least for a period here, that's very positive for corporate earnings, economic growth. And so it is a big tailwind. And that's part of why the stock market's up, 15% this year after being down almost 20, earlier this year. So one other thing I'll point out, stepping away from the budget thing, a lot of it comes down to the consumer. And I know, we've got ourselves kind of in this environment. You probably heard people mention this K-shaped economy. Jay Powell mentioned it last week, where the economic recovery feels like it's sort of benefiting one group versus another. In the group that it's benefiting are those people who probably the best way to draw a line here is those people who owned a home prior to COVID, or 2021, let's call it, before interest rates went up. So if you own financial assets, you own real estate, you feel the economy is doing pretty good. Your net worth has gone up, stocks are up, your home values have gone up. But if you are not one of those people, if you are renting, you're not participating in financial markets, it's been a real struggle. You've basically had to bear the brunt of higher inflation, higher costs, and you don't have the offset from financial assets helping you out. So we see a lot of stuff in the news about a lot of people struggling out there, and that makes you think like, oh man, maybe things aren't so good. So share a little bit of data here that I think shows in aggregate the consumer is in good shape. And so we start with the one on the left-hand side. This is a look at the last 10 years. And what we do is, the Federal Reserve takes all of the commercial banks in the US and they lump them all together and they say, okay, how much is sitting in checking accounts? And that's this line on the left-hand side. So pre-COVID, back in 2019, there was about $1 trillion that everybody had sitting in checking accounts that typically don't earn any interest, right? It's not in a money market fund. It was about $1 trillion. Then COVID happened. We sent all these checks out. We did all the stimulus, and we went up here to about $5 trillion. And that money hasn't left the economy. It is changing hands between folks. But consumers in aggregate have got a ton of sort of cushion, if you will. Now it's not evenly distributed. Granted, Jeff Bezos probably has a little bit more than me in his checking account, but in aggregate, there is a ton of cash out there that is available to offset any cushion or offset any slowdown in the economy. So some people lose their job. Maybe they've got enough cash to keep spending until they find a new job. On the right-hand side, we also saw this. It was an interesting kind of canary in the coal mine is this gray line. So this is, again, looking at all commercial banks, and we're looking at delinquency rates. The dark blue is all loans. So this is mortgages, credit cards, commercial real estate loans. And this is over the last 10 years. So delinquency is very low. But the gray line is credit cards. Okay. And credit cards were at sort of the highest delinquency rate we've seen over the last 10 years. Again, nowhere near where we were in 2008. If the chart went back further, it's much higher. But people were pointing to this as evidence like, see, it's that the part of the economy that doesn't have financial assets, they're struggling. But over the last quarter or two, we've actually seen that improve. So delinquency rates are coming down for credit cards. And so credit conditions for consumers are starting to actually get better. And so I think you take these two together, there's still a ton of money out there. The consumer in aggregate has a lot of dry powder to help them get through any sort of tough times, but we know it's not evenly distributed. And there are some people that are not participating anywhere near as much as others. And this is probably not for this, conversation, but this probably leads to more of this, sort of populist movements in politics. We saw the sort of outcomes of the elections, a couple of days ago on Tuesday. I think it creates more of a social challenge, even though, economic wise, economic growth can be real strong in aggregate. So, okay. Step away from this show. You can't do a presentation like this without talking about AI and how much money is being spent on data centers. So we take 7 different companies, and what we're tracking their capital expenditures. Now, remember, I mentioned that one big beautiful bill. Companies that are spending money on property, plant, equipment, data centers counts, they now get to expense all of that, all in the first year, which means they would pay less in corporate taxes. But the growth that we've seen here on the left-hand side, this is all before the one big beautiful bill, right? So this is happening without the tax incentives. And so what we've got on the left-hand side here is capital expenditures for Meta, Google, Microsoft, Apple, Tesla, Amazon, and Oracle. They're not everybody who's spending money on data centers, but those are the big spenders. And the blue line here on the left-hand side is their capital expenditures over the last 12 months. And so 10 years ago, they were spending $30 billion combined. Today, they're spending 340, right? So this huge growth in capital expenditures going to build data centers. But I would point out, we've seen these CapEx cycles before. The gray line here is the year-over-year change in CapEx spending. And we go through these cycles. Now, this one is bigger than prior. And so it's not unusual for us to see these huge CapEx cycles. This one's a little unique because it's AI. And it brings up the question, like, how much money can these companies spend? And so on the right-hand side, we took the same group of companies and we said, all right, well, let's take how much cash they have. These companies are all, sitting on tons of cash. We'll take their accounts receivable. So they've done work for somebody. There's money coming into them usually over the next 90 days. We'll include that as well. And how much cash they generate just from running their business. Okay, we'll take all of those and lump them together. We consider that dry powder, and say how much are they spending on CapEx relative to their dry powder, their ability to spend, and it's about 26%. Now, that is far more than they have spent in the past, but it is nowhere near how much they could spend if they choose to. And so we have seen over the last couple of months, some companies turn to the debt market, so issue bonds to fund their expansion, some of this AI, data center spending. Meta did a $29 billion deal a couple of months ago to raise a bunch of debt. Oracle did one a month and a half ago, $18 billion. And Google just did one this week. I think they issued 50-year bonds to fund some of their data centers. And the important thing here is all of these debt offerings were multiples oversubscribed, meaning there were more people trying to buy the debt than they had debt available. So there is an appetite to lend to these companies for these projects. These companies are extraordinarily profitable, so they're not even, they're not overextending themselves at this point. So we think this can continue. It's just a matter of, will these executives continue to find the ROI, return on investment, make sense? And we don't know. You listen to these executives talk on their earnings calls, and they talk about this like it's an existential race. Like you have to be one of the few companies that are a part of this AI ecosystem. Not all of these 7 companies are going to have an equal share. And so they're all racing, to build the best AI model, to build the best tools, and secure a seat in what will be a, enormous industry. But on the other hand, you look back and, people look back to the late 1990s. This is what happened with telecom companies. The internet was becoming a thing. All the telecom companies went out to lay fiber optic cable all over the place to connect the world. And the return on investment ended up not being there. That's how we got the dot-com bust. So we are hyper focused on what these executives are saying. We listen to every earnings call. We're dissecting, every piece of news that comes out, because this is obviously a big driver of the stock market, because so much of market cap is tied up in these names that are sensitive to this AI theme. So it bears watching. Yes, at some point this cycle will end. That doesn't necessarily mean it's Armageddon, but it's something we've got to really pay close attention to. Okay, just a quick look at earnings and expectations for the future. So this is a look at earnings going back to 2019, beginning of 2019. This is for the S&P 500. So aggregate all the S&P 500 together. Over the last 12 months, earnings were $242 for the S&P 500. If you look at 2026, so next year, they're expected to be 303 at the moment. So that's a 25% increase. So that's a large part of what the market is discounting, why the market's going to all-time highs, is the earnings expectations are that 2026 is going to be good. One big beautiful bill, consumers getting a little bit an extra tax refund, businesses being able to expense their capital expenditures, kind of boosting expectations. The one thing I'll point out though, I think people kind of forget this, but even though we've had a great run over the last several years, there was a period here between 2021 and 2024 where earnings were flat, didn't go anywhere, and so we've just now had several quarters where earnings have made new all-time highs, and so look at an earnings recession for the S&P of this magnitude. While it wasn't deep, it was prolonged, and this was battling with inflation. And so, look, I think it's not it's not unfathomable for these earnings expectations to come through, assuming the labor market holds on, and we need labor to pick back up, which is possible once these tax benefits start coming through, but we got to watch real closely, because like equity valuations. I think there was a Wall Street Journal article one of the team members shared yesterday. Equity valuations are extremely expensive. There's no way to get around it. But home prices are expensive. Going to the grocery store is expensive. Everything's expensive, in part because there's so much money floating around in the economy, kind of what I shared earlier. But so to provide some context here. So this is a little different view than maybe people are used to, but on the left-hand side, we have the earnings yield for the S&P 500. So most people talk about price to earnings ratio. This is just the inverse. And how you think about this is, if I were to just buy, if I could buy the entire S&P 500, all those companies, how much would I receive in earnings from all of those companies? And that gives you the earnings yield. And it's right about 4% or so is what you get right now. And so we compare that to, hey, well, what if I just went and bought a treasury bond? How much would I get from that, right? And right now it's about 4% as well, a little bit more than 4%, I should say. And so We compare this over time. So you can compare how expensive the stock market is relative to the bond market with this blue line over on the left-hand side. And this goes back to 1990. So this goes back a long ways. And so we're here. We're obviously we are the most expensive that we've been since 2022 in stocks versus bonds. So equity valuations are extremely high, higher than they've been in 27 years or 25 years. However, if you go back to the 1990s here, the equity market was more expensive relative to bonds for the entire decade, practically, except for this brief period here in 1997. So yes, equity valuations are extremely expensive, but the graph on the right-hand side takes every one of these data points here on the left and says what happened a year after that data point for the S&P 500. So the return of the S&P 500 is on the left-hand side here. The earnings yield gauge, this blue line, is plotted on the horizontal axis, and you can see there's not much of a pattern. While equity markets are high, the market could still go up 40% from here over the next year. Now, that's not our expectation. But so valuations matter in the long run. They don't tell you anything about what's going to happen over the next 12 months. So you got to acknowledge valuations are high. That probably affects returns over the next 5 years, but not so much over the next year. And so we're watching very closely for changes in economic growth. Obviously, there's changes in the labor market that might signal a change in tune, but at the moment we don't see it yet. But so yes, equity valuations are rich. Doesn't tell you what's going to happen tomorrow or next month or next year, but they are useful over the long run. So let me just touch on how we're sort of positioned. So I know many of you are clients, and so all of our portfolios are benchmarked against a global portfolio of stocks and bonds. And so these are sort of the adjustments. So some of the things that we do in there, we'll shave a little bit off of several positions in your portfolio to add to something else. So we're expressing our preference for certain assets over others. And so we are overweight large cap, U.S. large cap stocks, specifically large cap growth. So we have a bias towards those Magnificent Seven names, more growth oriented names, because as the economy has been slowing down, those companies that can continue to grow, whether the economy is growing at 6% or 5% or 4%, are going to be more attractive. And so on the other hand, you think of a company that's maybe more cyclical, like a General Motors, right? They need the economy to reaccelerate so they could sell more cars. Google, they're growing revenue whether the economy's at 5 or 4. So we've got a bias there. We're underweight mid caps and small caps, so you're still going to have a position in small caps. But we've shaved those positions down a bit to add to U.S. large caps. But the interesting thing I will say, outside of the U.S., this preference for U.S. or for large cap growth stocks is really a U.S. phenomenon. Outside of the U.S., it's actually the exact opposite. Value stocks do extremely well internationally because they do pay an extremely high dividend relative to what we could get in the U.S. So we are overweight international value, and we do have a slight overweight to emerging markets. So those are kind of some of the positionings that you see within an equity market or within your equity exposure. We are underweight high yield bonds, so these are riskier high yield bonds. However, we do own emerging market debt, so you'll have a small fund in there that is investing in emerging market debt, and that's because central banks outside of the U.S. have been cutting rates much faster than the Federal Reserve has. And so that's a tailwind to bonds of emerging market countries. And so that's been a pretty good trade for us. And then down here, we've got sort of our sector biases. So we're overweight communication services, we're overweight technology. So those things that certainly have been working. We're overweight financials. We've got a little bit in healthcare as sort of a diversifier, and then also in utilities. So let's see if I've got this. Let me just give you an example of this. And I mentioned U.S. growth stocks are, the total, bellwether. They have done far better than everything else over the last 15 years. But so these are some things we keep a bunch of charts for tracking sort of cross asset pairs because we're adjusting things in your portfolio to say, hey, let's put a little bit more here, take a little bit from there. And so on the left-hand side, this is US growth versus value. And really since 2022, it has been all growth stocks, right? It's been Meta, Google, Apple, Amazon. And so growth has wildly outperformed value here in the US. However, internationally, so this is looking at international markets, this is value versus growth, and it's actually the exact opposite. And so we sort of how we rationalize this is if you are a value investor, I want dividend income, you go to international markets and you invest in value stocks in international markets because you can get 4.5% more than you'd get from a treasury bond, right? A 10-year treasury bond. So there's definitely a preference for international markets, which have done extremely well this year, really driven by value. So Carl, I just took a glance at the time. You want to, should I pause for Q&A or where do you think we go from here?
Yeah, why don't you, for folks, if anyone wants to send in any questions as we finish up here, that way we'd be respectful of everyone's time and try to finish up here by one. You mentioned, I think you mentioned just more from a long, call it of a 5-year prospects, much more muted growth, call it on U.S. equities. I think JP Morgan's, kind of projecting around 5%. Are you guys looking, you think more of the growth area is ultimately going to be international? How are you guys thinking about that exposure called within the portfolio? Are there other areas or other types of investments you're including? I know you mentioned gold earlier being, very overvalued. How are you thinking about different asset classes if we're thinking U.S. markets are going to be much more muted?
Yeah. So, Carl, I think it was maybe the last time I was here. I had a chart, and gosh, I wish I would have included it here. So, let me phrase it. Let me provide some context. So, historically, in every cycle, there is always one asset class that does far better than everybody else. And so the last 15 years, it's been US large cap growth stocks, and it's blown away everything else. If you were to invest in Europe back in, let's say, 2007 to today, you're basically barely up. Right? We've gone 17 years with no returns. Now, international markets have done very well this year. They're up about 30%, better than the US. But I think if we were to start to see weakness here in the US, I think you could expect us to shift a fair amount out of US predominantly large cap growth stuff into more international markets. Because what we have seen over the last 5 cycles, there is this tendency for whatever is the best performer of one cycle to be the worst performer the next. And so right now, for the last 15 years, nobody's wanted to own European equities. They've been boring. They traded a valuation that's half of the US. But what ends up happening is you get everybody's chased the same US large cap growth stocks, and they're expensive. And so eventually when people start to pull out of US stocks, they want to de-risk. Ultimately, you're going to get more people selling US large cap growth because that's what everybody owns, right? And so I think there's a relative trade there that you would see us. We're not going to blindly, this isn't a prescription, but this is what we would look to. So I would see a much bigger participation in international markets from us. We have been, I think the last time that we were chatting, Carl, I think I was saying the only downside to gold is one that we didn't own it, and it hasn't pulled back and given us a chance to own it. Now we have seen gold come down about 10%. So some of the team is trying to understand sort of the drivers between foreign central banks buying and ETF flows. So we're diving into that currently. I would expect at some point, if we expected things to weaken in the US, I would expect gold might be something that shows up in client portfolios. And then a lot of it comes down to a lot of the stocks that the stocks that we own. So rather than owning something like a Micron or Arista Network, some of these companies that are tied to this AI theme, you could probably preserve a lot of capital owning a bigger chunk of something like, Walmart or, more defensive names. And so I think there's a lot that can be done even just inside the US equity market because we've seen such a run from some of these large cap growth stocks that a lot of names inside the US have really been left behind. They haven't done much in the last 5 years, and they're probably a safe haven if we start to see money coming out of US equities. Not many people own some of these consumer staple names that don't have the big growth story. So again, those are not prescriptions, but those are things that you could likely see from us when our tune changes. We just don't think that that's yet. So we're still in it for the time being, but we are turning over every stone, looking for where weakness might be coming from, to make sure that we don't overstay our welcome.
Is there anything that, when as you kind of go through that process of turning over all the stones per se, is there anything that concerns you or, you're really highlighting as maybe like one and two biggest indicators or thing you guys are tracking that, would lead you to, lead this market really down? I think a lot of folks now are seeing a little volatility and now you're starting to see people, the days that are down, they're, being oversold because it's, oh, everything's going to, go down now. But I think that just seems to be more general volatility. The straight run that we've had is not normal by any stretch, right? So is there
Yeah.
anything that you key in on and, do you guys just see this as just standard volatility and more normalization?
Uh, so 100%. This is just normalization. And just for context, and gosh, I have a chart that I was in another presentation, but let me just provide some context here. So we looked at every 15% correction in the S&P going back to 1950. So 75 years of 15% corrections, just to provide some ideas like, okay, how much do we bounce back under a good scenario? The recovery that we've had since April is the fastest recovery of a 15% correction in 75 years. So what we've seen since April is not normal. One, you could argue we shouldn't have been down 15%. The tariff thing was, kind of poorly rolled out. And then we got this tax bill, which, everybody, increased optimism. So we've had sort of a whipsaw effect. But yeah, what we've had over the last 6 months has been extremely unusual in terms of the magnitude that the market has risen and the limited volatility that we've had. I think the biggest peak to trough decline we've had since May is 2.5%, which is just nuts. So don't let the last 5 months set your framing. Expect a little volatility. It's normal. That doesn't mean, just because the S&P is down 1%, that doesn't mean the sky is falling. That's normal. And it's an okay thing. It's probably a good thing so that we don't get too far over our skis. But then the other thing, Carl, you mentioned, like, what are the things that we're looking at? I think we look at just about everything, but I'd say there are two ingredients, at least that we've identified, that if you go back to every cycle, that are sort of inescapable, which is a downturn in the labor market coinciding with a downturn in credit markets. So, and it's the combination of when companies can't borrow money because they need to roll over their debt or they need to make payroll, and these companies are always borrowing. When they struggle to borrow and they have to turn to making significant cuts to be able to borrow, is where things tend to be a problem. So at the moment, credit markets are extremely sanguine. There is no concern on the part of credit markets, which gives us confidence that we're okay. And then obviously the labor market, we talked about that. Labor market's weak. Part of it's immigration. Although we are watching very closely for those pieces of the labor market that tend to turn down first, to give us an early warning. And so at the moment, we don't see those things materializing. But we're looking at everything. Absolutely.
No, I appreciate that, and that's why we have you guys behind the scenes doing the work that you do.
Mm.
So With that, it doesn't appear that we have any questions for today. So I'd like to thank everyone, for joining. Phil, once again, thanks for the macro overview. I think it was really helpful in providing some context because I know some folks are a little bit concerned about where the market is and where it can go. And I think you highlighted the fact that at least in the near term, don't get worried about a little volatility. There's nothing that's, overly concerning, but we're tracking it. So myself and Phil will certainly work with you guys individually if you have any questions on just strategy and how to proceed with the current market. So once again, thanks everyone for this installment of Coffee with Carl. Thank you, Phil, for the time today.
You bet, Carl. Good to see you.
All right, take care, everyone. Appreciate it.